Here's the script, 886 words. In 2001, the United States Congress quietly rewrote a single section of the tax code and handed every one-person business in America a retirement account more powerful than anything sold on Wall Street. For 20 years, almost none of the country's largest financial institutions told their clients it existed. No one at those institutions has ever given a straight answer for why. By the end of this, you'll understand exactly what they didn't want sitting in your inbox. To understand what got buried, you have to go back further to 1978, when a benefits consultant named Ted Benna found a loophole in a brand new law and built the first 401(k). It was designed for employees of large companies, workers, contributing small slices of a paycheck, watched over by a plan administrator who took a cut. That was the model for 23 years. Ordinary people saved. Ordinary companies profited from managing that money. The rules assumed you worked for someone else. Almost nobody imagined what would happen if the person contributing and the person employing were the exact same name on the exact same tax return. Then came the change. In 2001, a law called EGTRRA quietly amended the tax code so a self-employed person with no employees could legally run their own 401(k), acting as both employer and worker inside one plan. That meant combined contribution limits far beyond an IRA, tens of thousands of dollars a year, sheltered from tax, deposited by one person into an account that person also controlled. But it went further than the number. Buried in that same provision was the right to self-trustee the account. No custodian required, no middleman holding the checkbook. The account owner could hold the checkbook directly, and with it, buy real estate, private companies, tax liens, even lend the balance to themselves. The official explanation for the silence when regulators or brokerages address it at all is complexity. They call it a niche product, unsuitable for retail investors, too easy to misuse, too risky for the average client to be trusted with. That explanation collapses the moment you look closely at what the same firms actually did with the exact same law. Fidelity, Schwab, and Vanguard all technically offer something called a solo 401(k), and all three will let you open one this afternoon. But strip away the marketing and you'll find every checkbook control feature quietly removed, every real estate and alternative asset option gone, funneling the same self-employed client back into the exact same mutual funds those firms already sell everyone else. The law never restricted any of this. The firms simply chose not to build it and chose not to say so out loud. Now watch what happens next, because this is where the buried detail gets strange. A self-trusteed solo 401(k) lets the owner take a loan from their own account, up to $50,000 at a modest set interest rate, paid back to themselves. Not to a bank, to their own retirement. For years, this went almost entirely unreported outside a small circle of specialized CPAs and self-directed custodians who built quiet practices around it. Estimates suggest fewer than 2% of the roughly 16 million eligible sole proprietors and independent contractors in the United States have ever set one up. Most have never heard the term. And here's what makes it harder to explain away as simple oversight. In 2013, the Treasury Department floated a proposal specifically targeting what it called abusive self-directed retirement structures. Aimed squarely at the checkbook control provision this same law had created 12 years earlier. The proposal died quietly in committee. No public hearing explained why regulators wanted to close a door Congress itself had opened. It simply vanished from the docket, and the account kept existing, technically legal, essentially unmarketed, exactly as it always had. So who benefits from that silence? Retirement assets under management in this country are measured in trillions of dollars, and the standard fee structure charges roughly 1% of that balance every single year forever to whichever institution holds it. A self-trusteed solo 401(k) removes the custodian entirely. No assets under management, no annual fee, no trailing commission on a mutual fund lineup. Every dollar that flows into one of these accounts is a dollar that never generates revenue for the firms that would otherwise manage it. That is not a coincidence built into a tax law. That is a business model quietly declining to explain the exit it is legally required to allow. The pattern repeats everywhere retirement law brushes against institutional profit. The rule stays on the books, the option stays technically available, and the explanation of how to use it simply never gets written down anywhere a client is likely to read it. Remember that fact from the opening, the one about who wrote this into law in the first place. Congress opened this door in 2001. Nobody sealed it since. It has been sitting open for a quarter of a century, waiting for someone to walk through it, while the institutions holding your money simply never mentioned the door was there. So ask yourself what else is already legally yours, written quietly into a section of the code you've never had a reason to open, that no one has ever bothered to tell you about.